All right, so let's start getting into the meat of things a little bit here. And let's start talking about buying and selling options and what that looks like as a very basic strategy. We're not going to go crazy here. We're going to understand what it means for you if you buy or sell an option. Well, there's only 4 things you can do. You can buy calls, you can buy puts, you can sell calls, you can sell puts, right? So it's fairly basic on a fundamental level, but let's really understand what that means. So in the previous lessons, we've gone over the terminology. We went over the pricing components. We did look at some of these aspects of buying and selling options and how that whole process works. Okay, along with why someone might want to do one versus the other. You know, if you've got a sentiment, if you're bullish on something, why you would do that versus buying a put. If you're buying a call versus buying a put, all that basic stuff. Just understanding how all these puzzles slowly start fitting together. These puzzle pieces start fitting together. So in this lesson, we're going to look at these basic strategies of buying and selling the options. But first, let's just do a quick little review, refresher, so you don't have to refer back to other videos if you so need it. So let's just quickly do a little review here. Calls and puts. That's the only thing there is. There's just 2 types of options, calls and puts. In a very, very basic sense of the understanding, if you think the price of an asset is going to go up, you would probably buy a call option. That would be the most likely thing you would do. If you think the price of an asset is going down, you would buy a put option, very simply. And for every buyer, there's a seller. There has to be, right? There has to be 2 parties to this transaction. So if you buy a call option with the expectation of that underlying asset increasing or appreciating in price, the seller of that option is generally taking the opposite view. Okay, that person thinks that either it's not going to go up or maybe it's going to go down. Selling a call option isn't really a bearish strategy. It's a bearish neutral strategy. If you really think it's going to go down, you would buy a put, at least in that given time frame. You know, maybe someone is overall bullish on something, but they don't think it's going to happen for 6 months or till next year or whatever the reasons might be. In the short term, they're happy to sell calls because they don't think it's going to go anywhere. So if you're buying an option, you would buy it to open a position and hopefully sell it at a higher price. If you're selling an option, you'd also sell to open a position, right? And hopefully buy it back at a lower price. Okay, buy low, sell high, buy low. 2 sides of the same coin. Or in the case of options, if you're selling options, you would let that expire worthlessly and you'd walk away with all the premium. Again, we don't do that too often. And we also learned that there's some primary components to an options price. Intrinsic value, which is the amount by which the strike price of an option is in the money. That's the intrinsic value. You can't take that away from it. So an option has intrinsic value if it's in the money. And that's the value that any given option would have if it was exercised today. So to understand the value, the intrinsic value, is very, very simple. It's simply those differences of price. There's no guesswork in there. There's no complicated calculations. It's just, you know, if you're $2 in the money, you have $2 intrinsic value. That's all there is to that. And then we have the extrinsic value, which we also call the time value. And the more time until expiration, the greater the time value because there's more time for that option to move around and become in the money, right? Plus, the more volatile an asset is, the more it's moving like crazy, well, the higher the premiums, the higher the time value. If you think about it as a seller, you're not going to sell something for a low premium when it's moving all over the place. You want premium cash for that premium, which then leads us into time decay, which is extremely important for anybody whether you're buying or selling options, because every single day of an option's life, there is time decay. The closer it gets to expiration, the less and less that time value there is in the option. And I showed a very simplified chart of time decay, and we can see the time decay is not linear, especially as it approaches expiration. It starts to really decay very, very rapidly once you get inside 60 days and 30 days, and then 1 week, it's almost straight down. One thing I'll mention regarding time decay, you can have an option decaying as expected. It's doing its thing. Then all of a sudden, boom, there's a volatility spike. The time decay is still there, but because of the volatility, the premiums can shoot back up. That can happen. That's something that's a volatility factor. That's vega, and we're going to talk about that later on. But ceteris paribus, everything being equal, an option will decrease every single day of its life at a relatively expected rate. There's always going to be some variables in there as the volatility changes, though. Okay, so talking about volatility, again, the more volatile that underlying asset, the size of the moves in a short period of time, the higher the premium it's going to fetch, because there's a greater chance of that asset's price moving in or out of the money, depending on which side of the equation you're on. So with all this information fresh in our minds, let's take a look now at some of those very basic strategies regarding calls and puts, buying and selling them. We'll also look at buying and selling the underlying asset as well, just to give a comparison of what it looks like in terms of what you could gain and what you're potentially giving up. Okay, I think that's very, very important, because again, there's only 4 things we can do. So these are the building blocks. And then once you start to layer them together, it'll make a lot more sense. And I will just mention before I get into this, these simple strategies of just buying a call, buying a put, selling a call, selling a put, again, they're not something we would normally do day in and day out. Occasionally we would do that naked, where that's the only strategy we're doing, but no, not very often. Maybe 1 times out of 10, maybe 1 times out of 50. Not very often will we do that. There's usually a very specific reason we would do that. So let's just take a look at this risk-reward graph here. And this is a risk-reward graph if we're simply buying, if we're long the underlying asset. Now, this could be a stock we're buying. This could be cryptocurrency. This could be anything. It doesn't matter. You're buying an underlying asset, okay? And on the left side here, we have profit. So the profit on the scale up. On the bottom here, this is the price scale. So the price of the underlying asset, okay? So price scale going horizontally, and profit going on the vertical axis. So let's say we bought something at $50. Okay, we bought this asset at $50. Wonderful. Well, if we bought a $50 stock, well, every cent it goes up is profit to you. And it could be unlimited. Theoretically, I've never seen a stock go to infinity before. Theoretically, it could go and never stop. So that's fine. The risk is the amount paid. The asset could fall to zero. It's a hell of a lot more likely than going to infinity. How many stocks are on the S&P 500 today that were there 50 years ago or 100 years ago? Only a few. So stocks go to zero all the time. So the risk is the amount you paid. Of course, the problem with this, and it's a perfectly linear graph, the problem with this is you had to pony up that $50. That's per share. It's 50 times 100. So you have to tie up capital to do this, but it's all gain. And don't forget, besides the unlimited profit, we've also got unlimited time, right? We can hold this thing forever if we wanted to. But there is a cost to tying up your capital for that long. We don't need to get into that. That's over. Well, we want to keep this very, very, very simple. So that is buying underlying asset, and what this risk-reward profile looks like. It's perfectly linear. So let's just move on. And let's talk about buying a call. Let's long a call. So again, we're talking about something that we want to get it at $50. So let's say the strike price is $50. Well, we had to pay a premium for that, didn't we? We certainly did have to pay a premium. And let's just say we paid $2.50 for the right to buy to exercise this at $50. Okay, so we want this thing to go up, but our break even has to be the difference between the strike price and what we paid. So it's $52.50. So everything above $52.50, boom, straight to the moon, Charlie, is pure profit for us. It's unlimited profit. But we don't have the time, right? We only have as much time. I'm just going to go just like that. We only have as much time as we have expiry date. So if that thing expires in 30 days or 15 days or 3 months, that's it. So it's got to make that move in that period of time. Don't forget, time is working against you every single day. This option is depreciating in value because of time decay. Let's not think about that right now. So the cool thing about this, so you've got this $2.50 right here, gap. So sure, I should have a zero here. So this is zero. You pay this premium, you get a gap. You're in the hole right away because you paid the premium because you're buying yourself a right to do something. You paid your money. Your break even's a little bit higher than before. If you just went and bought it at $50, your break even's higher. But you're only risking $2.50 times 100, so $250 if this is a stock versus having to buy it for $50 a share. So we're very similar on the upside. It's unlimited, but we have limited time. But we don't have the downside risk. If this thing falls to zero, who cares? We'll lose $2.50, and that is it. I hope this is very clear. Here's the break-even point. So it's the strike price that we agreed upon, plus the premium we had to pony up, and that equals our break-even there. Okay? So that's long a call. Now, let's talk about long a put. It's the exact thing. We just kind of flip the chart over, and that's what we get. Here, we want the darn thing to go down if we buy a put, right? If it's a $50 strike, we have to pay a premium again. We always got to pay a premium. We always got to pay the piper. So we paid $2.50 for this premium. That puts us down to $47.50 as our break even. Okay, there's a break even point. Strike minus premium, so $47.50. So every cent that goes lower than $47.50 is money in the bank, baby. It's money in the bank, but limited profits because it can only go as low as zero, right? That'd be great if you were long a put and went to zero. And again, just like with any option you purchase, you have limited risk. The risk is limited to the premium you paid. That's it. If this thing goes, and you're so wrong, you're thinking, I'm thinking this thing goes down, and boom, it goes to $1 million. Doesn't matter. We're just going to lose $250. That's it. Limited risk. Every time you buy or sell an option, there's the yin and the yang, gimmes and the gotchas. Two sides to the equation all the time. All right. So let's take a look at another example. And let's say we want to short the underlying asset. Well, this is exactly the same as if we went long the underlying asset. Remember when long we had that linear graph here? Well, here we've got a linear graph this way. We sold it short of $50. It's all gravy. It's all gravy for us if it goes down to zero. Limited profits because it can't go lower than zero. So wonderful. But here's the bad thing. If you short an underlying asset, this thing could theoretically go to infinity. Every cent above $50, you're losing money. And you had to pony up the dough to short it, right? It takes a lot more margin. So let's just take a look here. If we sold a call, okay? If you buy a call, you think it's going up. If you sell a call, you think it's not going up. Could be going down, or you think it's not going to move very much, or maybe go down a little bit. You sell a call at 50 strike, but remember, you get the premium. We just sold that to the guy who went long the call. Our break even goes up. So instead of our break even being at $50, it's $52.50, right? The strike plus the premium received, $52.50. Wonderful. Everything above $52.50, we're going to lose on. We're going to lose on. That's unlimited risk. Again, this thing can go to infinity. And remember, this is just basic stuff. We've got ways to mitigate all this stuff. So don't worry about that. But here's the thing with selling. You have limited profits. Your profit is limited to that premium that you received. And as a seller, you want to walk away with the premium. Maybe you let it go. Let's say this thing, you sell this 50 short call and it goes straight down. It goes down to $10. There's no chance in hell of this thing coming back. I shouldn't say that. The market can do anything. I've seen the craziest thing happen. But you think it's 1 in a million chance it'll go back and go against you, and you let it go to expiry. Well, you walk away with that full $250. Now, most of the time, this thing will get 25% of the money, 50% of the money, 75% of the money, and we'll just take it off the table. We'll just buy it back. We sold it high, we'll buy it for a lower price. We'll pocket the difference. Next trade. Very simple. The only problem with this is you've got the unlimited risk, and we'll be talking about mitigating that in the future. So let's take a look at the next example. What if we short a put? We sell a put. Now, the person who buys a put thinks it's going down. So if I sell a put, I think it's either going up or certainly not going down. Maybe it's just going to fart around or go up a little bit. Same thing. Remember, you receive a premium, right? So our break even, the strike price, minus $250, $47.50. So we got a little bit of a cushion, a little bit of a buffer there. So this thing can go below our strike price to $47.50 before we break even. Okay? Everything below $47.50 we're losing on, but it is limited risk because it could only go as low as zero. And just like whenever you sell an option, just like the insurance company, you have limited profits, but you get it up front. You get that premium from day one. The second you sell it, boom, it's money in the bank. It's in your pocket. Now let's just find a way to keep it. That's sort of the name of the game. So that's a short put. If this thing goes from 50 to $100, limited profits. We're only going to keep the premium we received. Okay? So that is a wrap for the basic functions of both buying and selling calls and puts. And we've also looked at buying or shorting the underlying, which is very helpful too. And, if you ever get confused when you think about it, just remember that whenever you buy, either a call or a put, doesn't matter, you have a stronger directional. If you're buying a call, you generally think it's going up, okay? If you're buying a put, you generally think it's going down. When you're and you're paying your money, like you go in the casino and you're placing that bet, as we've discussed, and you paid a premium, so that you have to get past that premium You have to overcome that deficit. So if you paid $2 on a premium and the strike was 50, you need to get it above 52 before you start making money because you had to pay for that. So you need to be very directionally biased, and it needs to really move, preferably sooner rather than later, because if the move happens towards the end of the life of the option has probably lost most of its value, and the move might not compensate for how much you paid for it. So a lot of people, when they buy options, if it doesn't do what they want within a certain period of time, or the option's value decreases by 50%, they just get rid of it. They're like, okay, I was wrong, it's out. Everybody's got some different rules with that. And the important thing to remember is that time is working against you when you're buying options. It's not working for you, it's working against you every single day. The value of that option depreciates as the time decays. So when you're selling options, it's the opposite. It's less directional bias. The option doesn't really need to move, and you still make money. It's fantastic that way. So you don't have to have that conviction. You don't have to say, oh, I really think, because I don't know. I rarely have convictions on anything. I watch the markets fairly regularly. But the point of this course for many of you isn't to become full-time traders and sit in front of your screen all day. It's you can check your phone 20 minutes a week and say, oh yeah, that looks good, I'll get in. You don't need to know anything about the underlying. These directional traders, usually they're waiting for setups or short squeezes or certain indicators to line up, and that's fine. That's okay. I do that type of trading too. But when we're talking about generally selling options, you can be a lot more relaxed about it. It's a lot easier to do in a matter of speaking. Sometimes it's not always so easy, but it is easier because you don't have to be right. I always say selling options is like playing horseshoes and hand grenades. You just have to be in the general area. I like that. And the nice thing too is you collect the cash up front. If you're buying an option, it's got to run. Then you have to decide where to sell. Did you sell at the right price? Did you get out? All that type of stuff. No, you just collect the cash up front. Okay, I just made $1,000 from this thing. How much am I going to keep? Am I going to keep $50 of it? I'm going to keep $250. I'm going to keep $500. I'm going to keep $750. I'm going to keep the whole damn thing. I don't know. It just depends on what happens, and we go through these scenarios. But you get the cash up front. You have the choice. You have the choice on how you want to try and manage that to squeeze as much out and keep as much of that premium that you receive as possible. All right, next thing, time is working for you. The second you sell an option, every single day, that time decay is a factor and it starts to appreciate. So that's always nice to have time working for you versus against you. The other great thing about selling options is you're able to fix them. And this is something we're going to get into later. It's very, very important. If I'm wrong, or maybe I'm not even wrong, maybe something's going swimmingly. It's wonderful. I just sold some calls and every day the value is going down. I'm thinking about buying them. And some big news event comes out. Boom, and the thing goes up. And it's past my strike price, and now it's in the money. Well, that sucks. First of all, I don't panic because I probably have, we'll talk about strategies. There's reasons why I don't panic. But I can always buy that option back at a loss and do something which is called rolling it. I can roll it out, I can roll it up, or I can do a combination of both. And that buys me more time to be right. It's kind of amazing. It's sort of like kicking the can down the road and you roll it until you're right. There's an expression, roll it until you're right. Now, do I roll it until I'm right all the time? Nope, not all the time. Most of the time, I do. But if my entire bias for the trade has changed, I might say, you know what? I'll just take that small loss and I'll just go to the next trade. You can't win every single trade. It's just not feasible. It's not, if someone tells you that they're full of it. There's a lot of options you can do when you're selling short options. Again, it's a more relaxed way of trading in many ways, but you can see there's gimmies and gotchas, there's yins and yangs, there's good and bad. The problem with only selling options, if you did it naked, you have unlimited risk, and we're not going to do that with you. We're going to do it so you're covered. But the money you can make is limited to that premium you receive. If you buy an option, boom, that thing can go up 1,000%, right? You can lose 1,000% if you sold an option naked, which we're never going to have you do right away. There's only very specific times when I would do that. So that is the basic functions of both buying and selling options. When you're buying, you've got that directional bias and you've got time working against you. And when you're selling, you've got less of a directional bias and you've got time working for you. And that's a wrap for this video.